Welcome back, everyone. Welcome back, viewers and listeners, to the Money Mental podcast. As always, we have Dr. Andrew Wilson here to deliver some pertinent data points, and it is a big week. We have had the first rate cut. Doc's going to take us through that. Doc, over to you, please.
Yes, thank you very much for that. And it is a big week. We've sort of preempted this. It was no surprise. I mean, everybody and his dog were saying the rates were going to be cut, and cut they were. Good news for those with a mortgage. Not so good news if you're relying on a fixed income from bank deposits. Good news for the housing market. Just comes with just at the right time for a couple of markets that were starting to reach their affordability peaks. This will refuel those markets, particularly Sydney, and maybe give a lift in confidence to the Melbourne market, which is well needed. But gee whiz, you don't need Adelaide, Perth and Brisbane having any more fuel because they're charging along on all 8 cylinders. So, there's certainly mixed messages in the media. I saw somewhere, no surprise, I think it was the ABC, saying how poor old housing markets are fading away. Gee whiz, have you been to Perth lately? Or don't you have a station in Perth? I mean, and Brisbane units up 40% in 2 years, and Perth house prices up over 20% over the past year. But anyway, we move on. They're the sort of headlines we don't rely on because they're not very useful for those making property decisions. But yes, an interest rate cut, the first one since October 2020. And is it the beginning of a cycle? I don't think so, because we don't have the usual sort of macroeconomic conditions, which is a weakening economy generally, particularly the labour market, that foretells further interest rate cuts. And even the Reserve Bank governor has said that. I think she looked a bit embarrassed, to be quite honest. But anyway, tough questions coming her way. Let's hope it all works out. But we'll go through all the minutiae starting right now. How's that?
Sounds good, Doc. One thing I do want to say just before we kick off is a very big thank you as well. You present every single week, but this weekend you did also present live to Infinity in our community. For those that weren't there, Doc was a little under the weather, but still powered through. It was a fantastic presentation, well timed.
Well, thank you very much. Yeah.
It means the world to our community, so thank you.
No, my pleasure. And by under the weather, I wasn't drunk this time anyway. It was just a bout of the flu, which came just at the wrong time. Don't know where I picked that up. Not sure it was a flu. I think they call it RSV or something now. But yeah, and I thought I'd soldier on, but the voice just went, and it's actually taken me till about now to get over it. But I'm not alone. I know a lot of people out there have been picking up bugs left, right, and centre. And it was just my turn at the wrong time. But gee, it was a fantastic event that Infinity held. There were, I think, nearly 600 people at the start in Broadbeach. It was just.
You must have enjoyed it as well. You stuck around to still answer some questions as well. Yeah, voice was fading, but I mean, you soldiered on.
Yeah, no, it was all good. But yeah, it was a big event, and certainly a very positive vibe there. And as we spoke to when we were discussing the economy, we said that, look, the chances are certainly very strong that we would get an interest rate cut. It's no real surprise going forward. And of course, good news for those that are thinking about getting into the property market for 2 reasons. Obviously, you can afford to pay more with a lower interest rate and a given income. But the other point is, I guess it's about the early bird catching the worm, because if this interest rate cut acts to refuel housing markets, higher confidence, better affordability, it means prices will rise. And getting in early, I guess, is just the secret to offsetting price rises coming through, because we've seen plenty of them in most of the capital city markets over the past couple of years. So let's get started. My Housing Market is my brand. I operate as an independent commentator and data provider. We have our own independent data sources, so it's not all about third-party data that we're presenting here. So it's not also just about the talk; it's also about the walk, and that reflects our data. But we do put together all the data points, not just prices and rents, to sort of create that big picture of what's happening in the housing market, because there are lots of other factors that determine housing market activity. And we've just obviously today we've just discussed and going to continue to discuss interest rates, because they are very important. And our little mantra there is the current state and future prospects of housing markets, and current state is important. We bring you this podcast every week with all the latest data so you are up to date with what's happening in the housing market, because you need to have not just robust and reliable data, you need to have recent data, and the most recent data you can, if you want to make the best property decision that you can. And that's what we're here all about with our friends at Infinity. Thank you very much to Infinity. So yeah, it's the week ending Wednesday, February the 19th, charging on. Here we go. We're really well and truly into the year in terms of housing market activity. We will look at the latest auction clearance rates for the week at the end of the show today, and that's a really good forward indicator of what's happening underneath in housing markets, and that's why we present that every week at the end of our show. So yes, this week interest rate decision. We'll look at the latest December quarter wages data that came through, quite interestingly, just briefly, and the latest weekly auction results. But the main game, of course, is drum roll, trumpet fanfare, you name it. Rates fall. It's the first cut since October 2020. So the RBA has cut rates. Big relief for mortgage holders, of course. Rates had been on hold since December 2023. So the first move since then, that was a rise over December when we were heading the other way, because the Reserve Bank had, there was some, question marks about whether it had increased interest rates as high as it should, but it sort of got away with that one. Now it's a question of whether they're going to get away with this one going forward. But rates cut, a relief for mortgage holders. So let's go through it. It is extraordinary. And the reason I call it extraordinary isn't because it wasn't predictable, because it was eminently predictable. And if you listen to our podcast, you'll know we've been saying that for quite some time. I think the Reserve Bank changed its narrative towards the end of last year. It started talking about moving in the direction rather than achieving the inflation rate that it targets. So it sort of had a much more flexible narrative in terms of its setting of interest rates. So we sort of felt, that means it's really going to, be a feel from the Reserve Bank rather than, hey, the rates, the inflation rate is at its midpoint target. So rates were cut by 0.25% to 3.15%. The first rate reduction since October 2020. Rate cut should be 4.15%. First rate cut reduction since October 2020. Rates were cut despite, and this is quite remarkable, that we have currently the strongest labour market in our history. It's not just that we haven't had low unemployment rates before and lower than where they are now at 4%. It's just that we are now pulling people into the labour market that have never been in there before. In other words, we have the highest participation rate on record. The unemployment rate is the same as it was a year ago, 4%. And the unemployment rate is also the same as it was during that very strong economic period in the mid-noughties, which was a boom period for Australia, courtesy of a huge expansion in our mining exports. So that's why it's extraordinary. Typically, we see rate cuts come when we sort of need a bit of a kick along to the economy, right? That's what it's for. Lower rates, create demand, get people spending again because they're not paying as much from their mortgage. And that's what's used. That's the lever for monetary policy to give the economy a kick along, to create some demand. And when we have higher rates, it's the reverse, of course. It's because our economy is going too strong and we need to slow it down. So this time, our economy is going pretty strong, and yet we're cutting interest rates. So, that's why it's extraordinary. And when we look back in recent history, we can see, just validating that particular thesis, that the last time we cut rates was with the onset of COVID. That was that emergency period there when COVID was hitting and the Reserve Bank started to cut rates. It cut rates all the way down to 0.1% official rates to try to stimulate demand, to try to offset the perceived impacts of COVID and the lockdown. Before that, we cut rates. The first rate cut cycle was in 2012, and that was the end of that early 2010s mining boom, when Australia was starting to join the rest of the world with stagnant economic growth and higher unemployment. But then we cut rates. And of course, the time before that in the modern era was in 2008, and that was the global financial crisis, when, you know, it really did hit the fan, not just in Australia, but everywhere, which was a significant overseas economic downturn. So we slashed rates there. So what's different here? Well, there's no economic downturn happening. I'm sorry, folks. In fact, as I said, we've got the strongest labour market in our history. And the other point is, okay, we can look at that. It's a strong economy in that overall measure. And I think it's an important measure, the labour market. We don't just look at factors such as GDP, which can be wishy-washy and not reflect what's happening in real economic activity, such as retail sales, such as the unemployment rate or labour market, and such as the housing market. So rates were cut despite a questionable inflation performance. Now, we have had a recent sharp cut or fall in the consumer price index. But why has that happened? Well, it has happened for two significant factors. First is we had a massive government handout which covered our electricity bills last year. So we saw a record fall in electricity prices, which does make up a significant part, or a significant part of our the basket of goods measured for inflation. So that really did allow the inflation rate to charge downwards. And the other factor that's pushed the inflation rate down has been the international price of oil, which has really gone downwards, not just over recent times, but over the past couple of years. We've got to remember, at its peak, it was around about $124 US a barrel. And that was so much a driver of high inflation during the lockdown period, the high price of oil. And since then, it's now hovering at around $70 US a barrel. So it's almost half of what it was at its peak. And that has, of course, had a significant impact on the inflation rate. So the point is, the Reserve Bank's been telling us over and over again, well, recently, that what it needs is a sustainable fall in the inflation rate towards the target range, right? So it hasn't said we've got to reach the target range. Now, the target range is between 2 and 3%. That is 2.5%. Now, we're not there. We're not even in the 2% or in the 2%. We're still in the 3% in the preferred measure from the Reserve Bank. But it's obviously happy to say, okay, well, we're happy because the trend is clearly there. We're moving towards the target rate. But is it sustainable? That's the key word here. They keep telling us, yes, we're happy that we're moving sustainably towards the target rate. Really? Sustainably? The only reason we have this low inflation number, or we've had this sharp collapse, the two key reasons for that are lower electricity costs and lower fuel costs. Is that sustainable? Is the government going to give us another handout for electricity prices? Are we never going to pay another electricity bill? Of course, we know energy prices, because of the change out of the carbon economy, have a lot of upward pressure on them as we move to a sustainable energy environment. So once the government stops giving us our electricity bills, which of course are paid by the taxpayer, we move back into that higher energy cost environment due to the changeover from the carbon economy. So you can't call that sustainable because it only occurred, the lower electricity costs, because the government paid our electricity bills. So sustainable? No. And the international price of oil? Oh, please. I mean, the word roller coaster comes to mind here. Seriously, you can't call, which is now been and continuing to fall, a lower oil price sustainable because it's anything but. It's up and down, up and down. As I said, it's nearly half of what it was during the COVID lockdown period. And yes, of course, that's because of the constraints through COVID lockdowns at that time. But, it's a fool's mission to predict the price of oil going forward. And again, sustainable? I don't think so. And the other point too is when we look a little closer at the latest inflation rate, inflation basically is divided into goods and services. Now, goods inflation has collapsed because goods are driven by the price of oil and the price of electricity, right? So yeah, of course, goods have fallen. But services inflation, which the Reserve Bank has told us over and over again they're concerned at, they're looking at that more closely. It's a problem in the US, but services inflation is still tracking at 4.3%, which is well above the target range, 2.5%. So, there are more holes in this than Swiss cheese in terms of the macroeconomic insights. And, it's will it be sustained? Well, only the future will tell us that. Then the Reserve Bank has said, oh, well, there are risks. And, we're not saying, it's all done now and things might happen. But surely you want to keep a little money in the bank in terms of your interest rates. If you do need to cut rates in the traditional sense, if there is an economic downturn, the more you've got to cut, the more capacity you have to stimulate the economy, rather than saying, hey, let's give everybody a rate cut. Yeah, it's all good. We'll be really popular, and forget about the big question marks over the macro economy. So I think I'm trying to explain this from a sort of a macro economy point of view. And there are certainly lots of ifs and buts and maybes going on here. And the Reserve Bank said, well, it's just a little cut. We're all cool. It's fantastic. But and of course, this will be welcomed by mortgage holders. And as I said, it'll be welcomed by the housing market. And it's going to be, particularly welcomed by the government, because we do have a looming election. Hey, pregnant pause. What's the elephant in the room here? Here we have a nice opportune rate cut, and we're on the verge of an election with a government who's certainly going to welcome it, given their position in the polls. So, I'm not joining any dots here. I'm just putting it all together. Those that are going to be happy about that interest rate cut, which, in my opinion, does not match the macroeconomy drivers. But hey, let's not be negative here. This is a good thing for mortgage holders, and it is a good thing for the housing market going forward. So let's just have a look at some of those bits and pieces. I went through them. The sustainability element, the oil price is falling. House building costs are a little higher. That's not the right move, in terms of trying to hold inflation. Home rent growth is easing. Yeah, that's a good thing. But recent signs show that trend is starting to move upward for rents again, even though they are still high. The labour market is still strong. Yeah, don't reckon that's a sustainable factor. High wages growth now easing. We'll look at that latest data which came out this morning. That's a good thing, that there's lower demand for wages, or for higher wages, therefore no pressure or less pressure on employers to cover demands for higher wages in a strong labour market by putting up prices. Retail sales still remain robust. The Reserve Bank says it's sort of a bit surprised at two things, and I don't like hearing the Reserve Bank saying they're surprised. We don't want the Reserve Bank to be surprised. We want them to know exactly what they're talking about, please. Anyway, so they're surprised at the strength of consumer sales, retail sales, and they're also really surprised about what's happening in the labour market. Gee, they're surprised. It hasn't really been off trend, the labour market, for the best part of 2 or 3 years. How can they be surprised? I think they've got to start looking at their analytical process here, because they can't keep telling us, we're surprised at this and we're surprised at that, when it is a key part of what's driving monetary policy. Of course, as has been said, house price growth still occurring, but is easing, particularly easing growth levels in Sydney, maybe Adelaide, but very, very strong still in Brisbane and Perth. And Melbourne's another story. It's certainly going to be welcoming a rate cut, but house price growth is easing. So I guess if the Reserve Bank, if it buys into that narrative, which has been promoted in some quarters, we'll be thinking, okay, we don't have a worry about, taking off, house prices taking off and creating more unaffordability. But the other point, which to me is a little bit questionable, is the US has clearly decided that it's not going to be moving anytime soon. And the Reserve Bank acknowledged this in its statement, that the US Fed has said no more rate cuts. They're going to rely on the data. And there are big question marks about that 1.5% rate cut that came out of the US last year. That was just before an election as well. I mean, crazy coincidence. But anyway, unfortunately, inflation is starting to raise its ugly head again in the US, and its economy, its labour market is very, very strong, like Australia's labour market is. And of course, when we're talking about the US, there is a person who's called Donald Trump. I'm not sure if you've heard of that person at all, but he is the new president of the United States. And one of his key policy agendas is tariffs. What a tariff is it puts a margin, a cost on top of imports, which means higher prices, which means inflation. There was really no word about that. The prospect of inflation coming through the international trading market and through the impost of tariffs. So, I would have thought there would be some attention paid to that. Yes, economic growth is slowing as measured by GDP, but for that lower GDP number, there are other factors that are showing an economy is strong, which we've sort of done to death. So the budget initiative reduced from last year electricity costs. Maybe there'll be more to come. But it certainly worked in terms of getting that interest rate cut. But it didn't get to the target range. And that was the prediction for Treasury, that the electricity cut would get to the target range. It has not got us to the target range in the preferred measure. It's got us heading towards the target range. So this is a bit of waffle coming out of the Mandarins in terms of changing their narrative in regard to interest rate changes. So there's our cycle, down and down and down since that cut way back in 2012 due to the end of the second mining boom, or second large mining boom. And then on and on we went, down and down and down and down and down, right through the emergency period for COVID, and then up and up and up because of inflation. And here we are, we've started the down cycle again. But have we started the down cycle? Well, we'll see. And certainly the Reserve Bank would, I guess, hope we have, because if not, I think the last thing they want to be doing is seeing inflation bounce back and some issues to do with maybe they cut too early, or maybe they didn't increase enough, which was the story 2 years ago. So rate cuts will refuel housing markets. There's just a quick slide that shows the relationship between house prices and interest rates. Their mortgage rates are currently at 8.8%, so they'll come down. But you can see there that there's always a response from house prices from cuts to interest rates. Why there wouldn't be? Our housing markets are all strong there. You can see the three bottom cycles, which are Perth, Adelaide and Brisbane, continuing upward movement. Sydney, this is December quarter data. Sydney also moving upwards, so they will be refueled by lower interest rates. Obviously shows that demand is still there. The black cycle there is Melbourne, which has really been going nowhere for a couple of years following that severe lockdown in Melbourne City. But this would be just what it needs to, you would expect, to help confidence as well as affordability in the Melbourne market. So we will await to see the outcome with bated breath. So just quickly, wages growth released today, up by 0.7% over the December quarter. That was a little less than the 0.8% reported over the September quarter. Annual wages are up 3.2%, again a little bit lower than the annual wage growth over to the September quarter, 3.3%. So this is actually good news for the Reserve Bank. It shows that wages growth is being contained. I think there might be a few ifs and buts here in terms of the measurement process for that, because it's sort of not, it doesn't really make sense given how strong our labour market is, but we'll take it for what it is. But the problem is that it means that real wages are falling, because wages growth is now below the inflation rate. So again, is not tracking below or close to the inflation rate. So not good news in terms of real wages, and that's what we're getting paid. And then we take out the price impact from the CPI. So, and you can see there that our wages growth has really fallen sharply since its peak during the high inflation period, and it's well down on the strong results we had in that mining boom period in the noughties. So it's been a long show. Let's quickly finish it off. And it had to be a long show today because it's been a big news show, and we've had to do all the ins and outs, the ifs and buts and maybes, to show you that we're right on the ball in terms of the data. So you need to be informed out there, and you've been informed in terms of what's happened with interest rates, why, and what the likely outlook is. So the latest auction results, another good early season result. Those early season auction markets continue to impress, particularly Melbourne and Sydney, which are certainly leading the capitals with listing numbers and clearance rates on the rise. And the prospect of an official interest rate cut is, which we've had, is certainly enhancing with these early positive results. Another year of solid growth in our housing market. So a good start to the year. This is the data, 1,000 auctions in Sydney, good numbers, good at clearance rate in Sydney, 78.8%, well up on clearance rate and listing numbers compared to the week before, and also well up to the year before. So good start to that Sydney market. Melbourne also a good start. It's tracking above 70 now for the third week in a row. Hasn't done that for a while. Good listing numbers, a little bit lower than the same week last year. But the clearance rate is just about the same. So some good, positive, solid results there for Melbourne. Brisbane, clearance listing numbers a little lower, clearance rate a little higher, and a little lower than a year ago, the clearance rate in Brisbane, but that was a very strong start to the year for Brisbane. Adelaide, clearance rate a little lower, listings a little lower. We've been discussing how the Adelaide market has sort of come off the boil after a very strong couple of years. No surprise there, affordability barriers, but still a good result overall for sellers. And, you know, Canberra continues to tease us. The listings lower, clearance rate around about the same, but better than the same time last year. We keep, you know, is Canberra going to rise? Is Canberra going to rise? It keeps giving us these little hints, but nothing sustained yet. But all will be revealed over coming weeks. And it's certainly a good start, particularly for Melbourne and Sydney early days. You can see there the monthly clearance rates so far over February, tracking ahead in Sydney compared to the same period last year, and kept tracking ahead of where it finished off last year. Same story with Melbourne, higher than the same period last year, and tracking ahead from where it was for most of last year. So some good early signs for that Melbourne market. Brisbane lower than a year ago. It was a spectacular booming market a year ago in Brisbane. Still strong, but that clearance rate was is still now getting back to what we call more of a normal result for Brisbane, as you can see from the other months. Adelaide, yes, as we said just before, a little bit off the boil, down compared to where it was a year ago, but not too far away from where it was to finish the year last year. And Canberra, is it going to revive? Well, a good early sign, but we've had plenty of good early signs. We need a bit more consolidation. Thank you from the Canberra market. If you're looking for the latest auction results, go to my LinkedIn channel, Doc Andrew Wilson at LinkedIn. You get the capital city snapshot around 6 o'clock every Saturday, and the full national report Sundays at around about 9 o'clock, which includes the regional breakdowns for Sydney and Melbourne, and also the top 10 sales under the hammer over the week for each of the capitals. If you've missed out on that National Weekly Auction Market Report, there is a QR code which you can get a PDF link or a link to a PDF copy of that file. As we usually finish off with, here's a giveaway from our friends at Infinity, the My Housing Market Suburb Data app. Again, you can scan that for a link to the app or a link from the link up there. Of course, you've got to get a password from our good friends at Infinity, so have a chat to them about that. But it is a great little giveaway. There's a screenshot. Tells you what's happening in every suburb in Australia that has data. It's asking prices and asking rents in real time. So you can filter for price or rent. You can filter for the capital city region or the outside capital city region. We're filtering there for Sydney, New South Wales region, Blacktown suburb, big suburb in Sydney. You can filter for house unit or townhouse. We're filtering for house and the number of bedrooms. So 5-bedroom house. And it's not just gives you the median asking price there. It gives you the low and the high. So you know the barriers between what's been asked for in prices in your suburb and the median, and also the number of properties for sale currently in that suburb. And it does exactly the same thing for rent. So what a beauty. And we've added this just for investors. We now have a page for investors there, which shows you the top 10 yields for each suburbs in those regions. So it'll give you the top 10 suburbs for yields, which is, of course, return based on rents and prices. Also the vacancy rate for those suburbs, and on the number of properties for sale and the number of properties for rent. So you can really take a scientific approach to modelling what's happening in particular suburbs Australia-wide. Nobody else does this, so it's a great little part of the toolkit to making good decisions for property going forward. Next week, January labour market. Is it still going to be super strong? The latest average weekly earnings is Perth still number one, and of course the latest weekly auction results. And if you want a copy of the whole report today, there is a QR code for that, and you can get a link going forward. So thank you very much My voice has stood up fantastic after my, I guess you'd call it a bit of a diatribe regarding a bit of a rave regarding the Reserve Bank, but that's our business. It's macroeconomics and the housing market, and we need to be right on the ball and understand all the ins and outs, and help hold everybody accountable for decisions that are so important to us as individuals in the economy, but also, of course, to the housing market. So see you all next week.
Thank you very much once again, Doc. So just to wrap up, mixed signals. Yeah, we've still got the rate cut. I don't think anyone's complaining.
Hey, no way. Not taking that one away, but, get out there and take advantage of it, I reckon. But you know, as I said, there's always two sides to this, and it's not good for those that are on fixed incomes, because they're going to see a lower deposit rate now. So that means they will be getting less of an income if they're on those fixed incomes. But just at the right moment for the housing market, this cut in interest rates, even though we've had such a good start to the year from our weekend auction markets, and we'll look next weekend to see if that continues.
Well, I think it will. I think we're going to start to see some of that filtering through. I look forward to the results. Obviously, yes. You'll bring those to us fresh, hot, and ready to go. So looking forward to that.
Yeah, and just on the auction market, it will be interesting to see if we get more buyers out and about this coming week as a result of that interest rate cut. We of course won't see more sellers, because sellers have locked that auction in weeks ago, but it can have an impact on buyers. We have seen that in previous times, that lower interest rates can motivate buyers to get into the market because of the fear of missing out.
Wonderful. Well, we'll see that all next week, Doc. Thank you very much once again, and thank you one more time just for everything over the past weekend. We'll see you next week for a fresh set.
All good, mate. Thank you.